A tax-efficient practice sale. Isn't that what we all want? That process starts not when you're signing the LOI, but many, many years in advance. You have to plan for the exit. So what does that mean? Planning before the exit. There are many strategies that we can implement along the way to help you optimize your tax efficiency on a practice sale. But that definition is different for every single client that we come across. I recently had an interaction with a client that went through the process of listing their practice, receiving a full asking offer, only to then realize that it wasn't enough at the end of the day, after taxes, after paying off debt. They weren't able to retire. How do you think that client felt? They went through that process, which isn't an easy process to go through, only to realize that they weren't ready. They weren't retirement ready. So rather than go through those steps, let's help you plan ahead of time the necessary steps to take so that you can retire efficiently. Let me give you a few key considerations as we plan for your practice sale. Number one, the purchase price allocation. How are we going to allocate the sale of your business? This differs for both the buyer and seller in terms of taxability. For the seller, we want as much as we can get into the goodwill or the capital gain category. Why? Because it's more tax efficient for a seller. You get better tax treatment on anything that's allocated as a capital gain or an intangible asset than you do for fixed assets or supplies. For the buyer, on the other hand, anything that's allocated as an intangible asset takes them longer to deduct versus anything that's allocated as equipment or supplies. They can take those deductions much quicker. So there's a little song and dance that you have to do between buyer and seller to agree upon a purchase price allocation. Now, there's not a ton of leeway there, but if you go into that with the wrong representation, you may end up paying more than you need to on the tax side. Number two, an installment sale. Now, this is not right for everybody, but in the right circumstances, this can be a great maneuver to help stretch your tax bill over many years rather than paying all the taxes all up front. Number three, plan for the year in which you exit. So what does that mean? That might mean saving up, right? You're going to pay taxes, so let's save for those taxes. Additional to that, that might mean let's plan to sell your practice at the beginning of the year instead of at the end of the year. Think about it. Let's say you work a full year, you make your full wage, and then we tack on to it a large capital gain. What that capital gain does is that pushes your income all the way into the very highest tax bracket, taxing your ordinary income at the very highest rates, which can have a very negative effect on your tax bill. Additional to that, there are many strategies that we can implement. For example, pre-funding or max funding or accelerated funding of your retirement plan in that final year of sale. There's many things we can do if we plan for them. And the fourth option is meet with an earned advisor to model after-tax proceeds, to help build and integrate a tax strategy into your deal, and ultimately help build a financial plan that supports long-term wealth and flexibility.